Welcome to the Broken Pie Chart Podcast, episode 251. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, CEO of ZEGA Financial, Jay Pestrichelli. Jay, what's going on today?
Derek, I was hoping we could do episode 250 one more time. No? We're going to move on to 151?
I think you should see the folder I have. I have 251, 250 version 2, for anyone who doesn't know. Yeah, we were ahead and then we were behind, and I don't know. So this is the real right number, Jay. So that's good. You know what wasn't real, though, is there's an article on Yahoo Finance, and they talked about a viral article, so an article that went viral, and claimed that 44% of homes this year were being bought by like BlackRock or Invitation Homes, huge institutions. Logan, what is this gentleman's name? Anyway, he wrote I'll put a link to it. Where's his? Mohtashami, I think is how you say his last name. So he wrote an article, Jay, and he said not only is the 44% totally wrong, meaning we're not seeing all these huge institutions buy up all the houses. It's actually something like 0.3% was the number. And so
Really?
he referred. Yeah. So here's kind of an interesting thing. He broke it down. He showed some data. He breaks them into tiers of investors. So he said a tier 4 investor who owns 1,000 plus properties, 0.3% is what was bought up during, I think, Q2 of 23. That's it. So all these people saying BlackRock's coming in and buying 50,000 homes, and nope, that's not the case, Jay.
Yeah, and when you say BlackRock's buying homes, it's like the private funds, right? That are or funds managed by large entities like BlackRock are adding real estate to their portfolio, right? I mean, they're not. Is that what that means, right? I mean, that's the way I interpret it.
Yeah, like if let's say you were running a private equity fund or a hedge fund, and you were going to buy single family homes. Okay, so how many of that is there in the marketplace? And apparently, it's very, very small. In fact, the 1 to 9 properties, these are tier 1 investors. They represent about 19.6% of the transactions. So I don't know, though. I got to be honest with you. If BlackRock was buying, with the money they have and the resources, I think if you were renting a single family home from BlackRock, I think you'd be pretty confident that if you had any maintenance issues, they would take care of it, right? I have no idea how the situation is, but that's just my interpretation.
I mean, your landlord is not BlackRock in those scenarios, right? So it's not the way that I don't think that's the way that it works, Derek. Right? So we do business with some folks that run private funds that hold multifamily houses in their portfolio. But they're just making investments in the companies that are running those, right, into the actual landlords themselves. I'm fairly certain BlackRock's not a landlord. I mean, I guess remove the corporate veil, right? I guess it all passes through eventually. But, that you're not writing to BlackRock telling them that your water heater's out.
All right. Well, I thought maybe I'd talk to who's the CEO of BlackRock. I'd call him directly and tell him.
Yeah, just give that guy. He's on CNBC all the time talking. He never talks about having to change somebody's locks and their cabinets are loose.
I think that's just on a broader spectrum, though. A broader point here, Jay, is that there's so much stuff on the internet right now, and I'll bet you a lot of it is not correct. And we see this even, in our business and just in general, the investing side of things, that anyone can write anything and it doesn't necessarily mean it's true. Like there's a lot of bad info that's out there. And some of it's, we talked about the Dave Ramsey thing even, let's not revisit that, the whole, you can take out 8% forever. But like 44%, and actually it's less than 0.4%. It's like, come on, do better, internet.
Yeah. I mean, there you go. Question everything you read. If anybody doesn't know whatever's on the internet is not necessarily true and verified, hello. But
yes,
I will say this about this, right? So when you think about the real estate market, right? I mean, I of course, like this is financing a lot of the 1,000+ property owners, right? The tier 4 investors that own 1,000+ properties. they're financing those acquisitions, right? And this is not the time to be financing acquisitions, right? So just with rates where they are, right? With mortgages where they are. So I am not surprised that such a small percentage of the properties purchased in Q2 of 2023 are, I'm going to call it institutional type fund purchases. So yeah, this makes sense, right? It's mostly individuals that are probably forced to do it.
Yeah, I guess real estate's so interesting. It's another, like, if you go onto YouTube, you can go down dark alleyways of content, or just, the crash is coming, the crash is coming. And I'm speaking personally. I'm not a real estate investor, so these people could have good insights. They might not, but it goes back to what we always say. Imagine going back a year ago, and interest rates are going to rise, and so mortgages are going to be more expensive. You would have thought housing would have taken at least a more of a little bit of a tumble, right? No, because it's a supply thing. There's not supply. I mean, I talked to real estate agents out here in Scottsdale, Arizona, and they say, they're hard pressed to get listings. There's nothing, because people are holding on to their low rate mortgages. So it just it's tough to try and pick tops, bottoms, entry points in markets. So anyway,
Yep,
uh,
absolutely.
all right. Talking about markets too, Jay, I don't know if you saw that call option trading. Who put this out? CBOE Global Markets. Looks like, I'll call it, about 42 million contracts traded call side. I think that's a record according to the CBOE. Jay, this could be a little bit of, we're nearing the old highs in the market, so naturally, probably more call buying than at these types of levels. But also, people are using derivatives.
You think call buying, Derek? Really?
Well, I'm just going out on a limb here.
Well, I would say, what have we been doing, right? We've been selling calls here, right? So, by the way, I don't think you're wrong that it's coordinated. It's tied to the price of the market, right? As markets are going up, calls end up having more activity. But market goes up to this isn't for certain strategies. I should say, we're not across the board shorting the market. Don't get me wrong. But for some of our strategies that sell options, we've been selling the call side, not the put side, haven't we?
No, that's right. And our listeners cannot see the chart here. There are these sort of spikes that happen. Seem like it's pretty good intervals. I wonder if that is the monthly rolls for covered calls that kind of happen there. That could be it too.
It could be locking gains. Like, let's say you were long calls and the market's pressing to a new high, and you want to kind of lock your gains and re-hedge. That's a tactic we use as well, right? Right, when you're using long calls as stock replacement, there is this nice little thing where right, the reason you use that is the most you could lose when you purchase a call is what you paid for that call, right? That's the most you could lose. So it's naturally a hedged position. So if the market really goes down, okay, I can only lose what I pay for the call. But if the market goes up, that call is going to appreciate at whatever rate it appreciates along with the market. And so at some point you go, hey, like, if I bought a call for $30 and now it's worth $90, I could I could sell that call, and then not cover by sell that call, make my $60 and turn around and buy a new call for $30 and still be exposed to the market, and then while putting $60 into my pocket. That's a tactic we'll use from time to time in the buy and hedge retirement strategy that we run. So I think you could be right. It could be the rolling at new highs where there's a sell and simultaneous buy, because it locks in gains and you put some cash in your pocket, and then you're still invested. It could also be tax harvesting, right? Like, there's a lot that's kind of going on this time of year as the market's pressing to a 2-year high. Actually, I think the Dow closed at a new high altogether today, Derek. And not that we follow the Dow often, but I did see that headline go across.
Yeah, congratulations to the Dow. You can get your Dow 3700 hat on and display that with a lot of confidence, I guess. If you remember, that was a deal. Remember, it was like Dow 10,000.
Every 1,000, there was a new hat. Yes, of course.
The
Art
people on the
Cash was every
NYSE.
single one of them. Yeah.
I don't doubt he is. He has those. All right. So moving along, Jay, though, the Fed did some stuff this week. They had a little meeting, and they Powell, I think, is like, no, we're not talking about lowering rates. Then they follow up, some of the talking heads from the Fed speakers come out, rate cuts? No, we're not even talking about that. The Fed funds futures market says March is 62% probability of a quarter point cut in rates. Now, I don't know. We'll see the Fed funds futures. They move around. The probabilities change, but feels like they're done, at least as far as raising rates. Wouldn't you say?
Yes, and even they would say they're done, although they have said, well, if the circumstance required, we'd raise again.
Blah, blah, blah,
Um,
blah. Yeah, I know.
yeah. But look, they only have two tools, Derek. They could change rates or they could talk about changing rates. So right now they're kind of flexing, that the talking part of it. And but you're blah blah blah. What, you think they're not? They're disingenuous when they say something. Look, I would say it certainly feels like they're done raising rates. CPI was what was CPI this week, right? Because we got that right before the Fed meeting. Pretty
Slightly
good, right?
positive. Yeah,
Slightly
slightly positive.
positive, right? So it's retracted. Although we're not at their 2% target yet. So I do think that they are true to they'll continue to follow their guidance, which is, until we're going to stick to our guns until we can get to the 2% rate. I do think they'll stick to that, and they're not there yet. And yes, I agree. There was a Fed governor this morning saying that he believed March was a little too soon to consider changing rates. So, yeah, but the market is trading as if they're going to. I don't know. Like, what's going to make them do it, Derek? I know it's Groundhog Day when we talk through that, but I don't know what's going to make them change rates. Certainly in March, I don't know what would cause that.
Some weakness in equities, really, or
but that's like
banks.
3 months away. Like, I don't know, 4 months
know.
away. I don't know. It's close.
So the last raise in 95, I think, was March, and by September they had lowered rates. So that's about what? 6 months.
September.
Yeah. So when was the last raise? They did a quarter. When was that, Jay?
July? Then I got to go look back, but it was something like that, right?
Yeah,
they stopped, and then they did the dovish raise. You remember whatever that nonsense meant? It's a dovish raise, and there was a hawkish pause followed by a dovish raise.
Yeah.
I don't even know what that is. So,
Tom Lee's Fundstrat, by the way. So I saw a graph that I think is interesting, and yeah, the source here is Fundstrat. That's Tom Lee. So what they did was they took the 1982 period, and the S&P troughed, meaning it hit its low August 12th of 1982. And then for the next 37 days, it was up 19%. Voelker, October 5th, 1982, declares victory, meaning, we did it. We whipped inflation. And what he shows is afterwards, there was continued strength. And 1, 2, 3, 4, probably the next 7 months or so. What they've done, though, is they said, look, 2023, the trough was October 27th of 2023. And they're saying 12/13, the day of the Fed meeting, from trough to the Fed meeting, plus 13 or 14% over 33 days. Powell declares victory. And the question is, continued strength with a question mark. So our visitors, our listeners can't see this chart, Jay, but it kind of looks really similar. Both the lead up to the trough and trough to quote unquote victory. So yeah, it seems go market. I mean, I'm in for this. Let's see some more strength.
You're in for market strength.
Let's do it. Yeah.
Let's have market strength. So if they're going to use the Voelker example, right? They say the S&P goes from, what is that, 120? what is 120 to
160.
160, right? So, back of the envelope says that's 40 points on 120 is a 33% increase. Is that what Tom Lee is saying here? I don't know.
I mean, he says it's going to go from 114 to wherever, I guess. I don't know. We'll see. We'll see.
Yeah. So great. Look, there's a lot of things, like we're starting to see some maybe obscure comparisons of some past kind of one-off scenarios. I think we saw an article the other day where I think it was from Carson, which was talking about if 60% of stocks, are above their 20-day moving average over the last 20 days, 100% of the time the market doubles in a year. Like there's been some now I'm wishing I wrote that data points, but I shared the article with you, Derek. So correct me as I'm stalling if you want to. But essentially what I'm saying is we are starting to see a lot of kind of obscure reasons and obscure historical references that tell you, the coast is clear, right? Soft landing, this market's going to roll higher. Here's some data points from the past, and they should help you infer for the future. Markets pressing new highs is always, gives you optimism and makes you feel good about the market. I don't know, could I have found other examples that Tom Lee is producing here where the market has had, kind of a rebound after a decline related to what the Fed said, and then it didn't go up? Yeah, I'm sure I can. So, this, I don't know, Derek. I'm going to go back to don't believe everything you read on the internet as you started us out today and say, here's a single data point. I'm certainly not going to change my investment thesis because of this. Sorry to be a naysayer.
All right. Well, you just told me not to believe anything I read on the internet. I'm going to read an article you passed me, and it was an extremely rare stock signal with 100% accuracy rate. This is the one you were just referencing, is flashing.
Yes.
And points to record highs in 2023. Ryan Dietrich, who is the analyst, noted that 60% of all components in the S&P hit a new 20-day high. This is a breadth thrust type indicator. And basically since 1972, this rare signal has flashed 15 times, now counting last week's signal. The S&P was higher a year later, 100% of the time after the signal flashed, generating average return of 18%. So there you have it, Jay. 100% of the time, right? We're good.
100% of the time. It works every time. Yeah. Sorry. I think he says the quote from Anchorman, right? 60% of the time, it works every time.
That's right.
I had to throw in a reference there. So look, again, I know I sent that to you and we read it together, but I don't think that, it's just an example of some obscure kind of data points that we're putting out there. So are markets going to go higher over time? I think you and I would say yes. You don't need to give me this one-off weird thing to prove that to me. Do I know it's going to happen in the exact next few days? Doesn't matter, right? I'm not timing the market, right? I'm invested. When I say the way we talk to our clients, right? The way we talk to, we talk about planning. It's not about the next 37 days. It's not about the next 100 days. It's about what's going on your plan and over time. So yes, of course, we're going to stay invested in the market. It's a decision actually that you and I made along with our investment committee early on in the year, right? Which was, at the time the recession was imminent and pretty much guaranteed. And we said, it doesn't matter. Our strategies that are designed to be invested in the market are invested for the longer term. So we're going to stay in the market. We're going to stay bullish. And so we did, right? We kept our assets in the market. We didn't draw anything out. We didn't say, let's just run to treasuries and be safe, right? I mean, but for clients where that was appropriate, it's fine. But it was generally speaking, stay invested in the market. Markets generally go up. I love it that there's more data that points to that. But this kind of, again, obscure information is not going to change my, our base thesis and approach, right? Nothing has changed for us at this point.
No, we buy and we hedge, and we listen to everything on the internet, apparently. All right, Jay. So another thing from the internet, and this shouldn't surprise people. Let's maybe go I don't want to say the bear case, but the contrarian case. AAII survey, which is the American Association of Individual Investors, they do these surveys, and this is the bull minus bear spread. and they survey people and their individual investors. And no surprise, the market's coming up towards all-time highs again. And it's the most bullish people have been since, well, 2021, the last time we were at really all-time highs. So I think just it's not surprising because it's hard. And people are, when the market's doing really well, whether somebody's filling out a risk questionnaire or whether they're filling out a survey, they're more apt to say, yeah, I'd like to be invested and I think the market's going to do better. When things are really bad, probably when they should be maybe adding some stuff on the sidelines into the markets, they say, oh, I want nothing to do with it right now. Leave me in cash. So I don't know. Might be a little contrarian, but maybe it's just catching this continued wave of, yeah, everything's good. Markets.
Yeah, no, I would agree. This is definitely a contrarian indicator. When you look at when this thing makes its peaks and troughs, right? The high, you're right. The previous high was 20, and this might even be a little higher than where we are today. Was 2021, and then the most recent low was, oh, guess what? October. It looks like Q4 of 2022. So this essentially is a reflection of sentiment, in my opinion, and our market's up and people are bullish. Yes, guess what? So this indicator's I don't know if it necessarily means the market is going to turn down, but just in October, like 2 months ago, when I'm looking at this, or maybe it was September, it was at a level that we saw during the pandemic of bearish. So I don't know. This seems, again, a little schizophrenic. It could definitely be a contrarian indicator, right? That you could take a look at, but we also haven't made an all-time high in this thing, so people could get even more bullish from here, and then that would be fine. It's that's the trick about contrarian indicators. It's like, hey, when everybody says one thing, you should go the other way, but you got to know when to go the other way. That's a hard thing about being a contrarian, right? So,
do you mean like 28 out of 29 leading economists who said we'd have a recession in 2023? That type of
yes, that kind of a contrarian. Everybody's on the same side of the trade. You want to be on the other side. All right, look. All right, so here's a question. I'm gonna throw an ad hoc at you. Besides the market and lack of fear in the market, which I know we're going to talk about in a minute, what's the other obvious contrarian indicator? The trade that everybody's on the same side right now. What is it? Is it rates are going down? Is that the trade that everybody's on the side of, or is it?
I think that's fair. Everyone, quote unquote, everyone knows rates are coming down. That's what you hear right now.
Yeah,
it's popular.
I feel it reminds me of, I'm going back years here, like 2013, 2012. Everyone, hey, rates are going up. Sorry. So they have to come off, and it took a long, long time for rates to move, right? We stayed low for a long, long time.
Right. You're talking about post-financial crisis. Rates were low, low, low. Everyone said, because we remember there were a lot of products too that were hedged interest rate products where they'd hedge rates going up, and investors would hold these, 3, 4, 5 years, and they just waste money on hedges because rates never went up. In hindsight, would have been a good idea if rates went up, but I agree, Jay. I think everyone says the dollar's going to be lower too. Now, not as many people trade the dollar or things like that, but conventional wisdom right now is dollars going lower, interest rates are going lower, and the economy is going to soften. What's the du jour prediction now? Q2 of 24, but it's going to be a short one.
Apparently, we're going to be lowering rates before that, according to the Fed funds futures.
I guess. I don't know.
I'm going to throw another ad hoc at you. I was talking to a client this week about rates, and his feeling was, well, even if we don't even if there isn't a cut in rates, they're not going to raise rates, right? So why would I not just buy an ETF like a
TLT?
I'm gonna like TLT, right? Why would I not just buy TLT, Jay? Because if rates are going to be flat or down, like I can't really lose on that trade, right? And I had to correct him, and I don't want to spoil it here, Derek. Like, what would you say to a client who said, "Oh, look, TLT, it can only get better for me because rates will come down, and that way TLT will go up"?
I mean, the question is, if the economy is really strong, if we have good economy, and you would say, okay, well, let's say the Fed lowers 100 basis points, and which would bring to 4.25. Okay, so then you got to ask yourself, what's the 30-year bond going to be priced at? Is it going to be
Ah,
priced
that's the
exactly what
trick.
it is, right? Is it going to
Yes.
be, or are you going to get a term premia, as they say now, and is that going to go to 6 when short rates are 4? Like normally it's not inverted. This is weird. Short rates should not be that much more than long rates. And even in a non-inverted curve, you're going to say, well, pay me for the risk of buying bonds that are going out further. So that's the thing, Jay.
Yeah, I mean that was the point to that client, which was, look, even though you could be right that the Fed won't change rates, you could be wrong on the direction of the 20-year Treasury, which is what TLT kind of averages, right?
Yeah,
20
sure.
plus. You could be wrong on that, and the curve can revert, get back to the normal curve where farther out in the curve you go, meaning the longer in duration on the bond, the higher the interest rate, which would mean even as Fed rates are coming down, the longer end of the curve could go up and then you could lose. So I just thought I'd bring that up because we're talking about rates and bullish and where everybody, the bet that everybody's on the side of. The TLT trade, which is, by the way, one of the most popular ETFs to trade, can still be very dangerous when you take into consideration duration and rate curve changes.
Yeah. Now, if somebody was to say, hey, Jay, I'm going to buy a 1-year Treasury because I think, you know what, rates are not going to go up from here. Well, to be honest with you, you pretty much, there's not too much interest rate risk at that short end of the curve. But I would say, yeah, that's right. If you buy a bond right now, pretty much you should expect to mature at par, which is $1,000 or $100 price per bond, and you collect any coupons or you collect any difference between what it's trading at now. But no, I think you're right, Jay. I mean, it's the longer end. I mean, now you're getting into picking the spots on the yield curve, and I can tell you one thing: even some really smart people on Wall Street got that way wrong this year. So
You
we've
mean the
seen
ones
that.
that put their banks out of business? Those guys?
Well, them or said January of 23, our pick for the year is long duration treasuries. All right,
Oh
well,
yeah, yeah. Oops.
it's hard. All right, so here's a couple of the things. I do want to talk about VVIX and VIX because we saw some interesting things there today. Just a quick hit: the Atlanta Fed GDP now estimate, which is a nowcast. Every bit of data that comes in, they're adjusting their model for Q4, which won't be released until the end of January of 24. It ticked up again. So now I eyeballing this, it's about 2.5% is the annualized rate estimation for Q4. This GDP is confounding people. They thought it was shrinking. They thought it would shrink. It hasn't. But let me throw some what's it? Bug in the ointment? Is that the right thing? I don't know.
Fly in the ointment.
Yeah, fly. I guess fly in a bug or
I mean, a
well, it could
fly's
be
bug.
different.
Great.
It's a bug. I mean, would you rather have a bug or a fly in your ointment? I don't know.
I don't want anything in my ointment
Let's
except
not.
ointment.
Yeah, I would think ointment is better unencumbered of bugs. All right, so if I want to put like a negative thing, we got to talk about advanced real retail and food services sales. So anytime you hear the word real, it means adjusted for inflation. You keep seeing, and it's always interesting to me, Jay, that some things we put out, like GDP, that's real GDP, and then it's annualized. Other things we put out are not real, not meaning they're not real. They're nominal, meaning not after inflation. And they might be annualized, they might not be annualized. So a lot of times on CNBC, you get retail sales. It's not real retail sales. And the point of this chart is before the last 3 recessions, you actually saw real retail sales trading sideways a little bit, or I shouldn't say trading, the chart looks a little bit sideways. And I think it was March of 21 was the recent, the last high in real retail sales. So I don't know. I mean, you could say 2020 and that whole period kind of threw everything for a loop. But, if I'm looking for dark clouds, there you go. If you're bearish,
Yeah, I look. I think we all know that pandemic period in 2020 was caused by something non. economic forecasts, if they happen to predict that, just got lucky, in my opinion. But when you look at the '08 and the '01 recessions, you're absolutely right. This data point trends sideways, right? This advanced real retail and food service sales number goes sideways. What I don't think, and I get it that this is accounting for inflation, but I still don't think it accounts for necessary behavior. And we have been sideways on this number for over a year. It's actually slightly lower, Derek, right? So
It is.
when I look at this, I don't necessarily know it's predictive of. And I would have believed it more if they weren't, pointing to the 2020 period as like, oh, this predicted that. Nothing predicted that, right? So,
Well, the yield curve did, Jay. It was inverted in
oh,
2019.
whatever. Stop.
Come on.
Stop.
It's a win. A win is a win. I'm sorry. You got to give the yield curve a win on that one. It is what it is.
Even a blind squirrel gets nut. A broken clock is right twice a day. Fine. I'll give you that.
Put the eggs all the eggs in the basket or whatever that frame, 6 half dozen. So I don't know.
Flying the ointment here, meh. I'm like okay with that. I mean, I do think people are kind of cutting back some of that spending. I do think they got a little less money in their bank account. I do think all of the stimulus is starting to run its course. So, none of that's all worked into this, right? We went through a very unique period from February 2020 till today. We're still working through all of that, where interest rates are and everything, the flooding of money into the economy and consumer spending and then inflation and
all
supply
right,
chain.
Fair enough.
Fair
enough.
Come on. Okay, thanks.
Fair enough.
Meh. Again, I'm not. I'm negative Nelly today, dude. Sorry.
Well, I've been really bullish, except for these last ones. But let's think about what the VIX is showing us. And speaking about working itself out and figuring out the regime, you and I have always said that lower volatility doesn't necessarily mean there's going to be a spike. We do look at different measures of volatility to try and tell us that, but it's low volatility begets more low volatility. Jay, today the VIX itself was down to 12.28. That's the spot VIX, the one you see on TV. It was down about 1.6%, which, by the way, is only 20 cents. Something interesting happened, though, in the VVIX index, which, of course, is the volatility of the options on the VIX. And it went up to 88.04. That was almost a 9% increase today, gained about 7.2 points. So, Jay, we have a day where the VIX was lower. Yesterday, the VVIX was unchanged. So maybe it saved it all for today. But it seems like when we think about the premium levels on VIX options, which are buying options or selling options, not on the VIX index that you see on TV, they're actually buying or selling options on the VIX futures contracts. They got more expensive today. Let's just put it that. But I think we should talk about this because I noticed it. I know you and I didn't even talk about this prior to the recording the podcast here today, but when I mentioned it, immediately you said, "Oh no, I saw that too."
Yeah, so we watched that index, the VVIX, because it indicates where money is flowing to on options on the VIX, right? And so when that pops, it means people are willing to pay more for options. And I'm taking a look on the VIX option chain, right, where they were, trading today. And there was obviously, kind of the normal 1 week out trading where there was a lot of volume on, the calls at the 15 strike on the calls on VIX. So what does that mean when someone's buying a 15 strike call and they're paying, let's see what the price is on this thing here. I mean, they're paying 12 cents, right? So they got a week that they're, looking for the VIX to be above 15. So that's a significant kind of increase from 12.2 to 15. They're only paying 12 cents for that, right? So it really wasn't very expensive. But where the real volume was you got to January 24th, which is about a month away, right? When you take a look a month out, a lot of the volume was on the 17s. And they were paying 80 cents for that if they were buying it. So what does that mean? 180,000 contracts traded there. So that's a significant amount of flows to taking a position that the VIX will close above 17 in 30 days. So that's from a 12 to a 15. And even, based on a lot of the metrics that we watched, Derek, we would say that would be, a fairly extreme move, right? To move that far. I mean, certainly the VIX could do it. The VIX could do that in a day if it wanted to. But, that 50% appreciation in the VIX is where a lot of the money was flowing into today. So it's telling you there's somebody out there bracing for a sell-off, or just taking a speculative wager on an increase in volatility.
It's always interesting too that we'll see these big pockets of, I'll say, volume come up where people buying index options on the VIX. It feels like when the VIX gets lower, there are people who naturally say, well, it becomes a cheap hedge. And I think you made this point a few weeks ago where when VIX is at 20, you say, well, maybe they'll buy the cheap options. They got to go to the 30s. And 30 is still a pretty good level. At a 12, and a half, or slightly north of 12 VIX, as you said, I mean, you can start to go in these lower double-digit areas for the VIX, and it's not too expensive. So if you get any sort of spike, but I still say, Jay, and especially the few weeks before Christmas and the holiday season, we typically see the kink in the VIX where there is lower volatility, especially before the holidays. So I don't know. I mean, I understand why people do it, but just because the VIX is low doesn't mean it's going to pop. It's not. It doesn't really work that way.
No, and it could stay low for longer than people expect. You and I are in the camp, I believe, that not to speak for you, but I think you agree that it appears that we're starting a new kind of regime in the VIX, right? Where we talk about the VIX kind of stays in ranges for years at a time. Well, this recent move that we've seen here now, I think we saw the VIX the other day below 12 intraday. I'm not sure if it actually closed there. Sorry. But this could be something where the VIX gets down to 10 and hovers between 13 and 10, or maybe 15 and 10 for quite a while. That has absolutely happened before. So it's not unfathomable for the VIX to stay low. And what does that mean? That means VIX low means people are not willing to speculate on options in the S&P, right? So it actually, it's great for option traders that like to use long options for hedging, or even long options for, upside capture. As we started the conversation, we're talking about long calls, or at least early on. Look, a VIX lower regime means it's a little harder to make money selling options versus buying them. Maybe it's a little less punitive on time decay, but it could remain low for a long time. Nothing says it can't. Look, we like to take advantage of it when we see it drop to this level. I think we talked about either last week or a few weeks ago that we took advantage of low cost of hedging and added hedges to our portfolio. Do I wish I did that this week rather than last week while the market is, a little higher? Of course. But again, we're not timing the market here. It was a good time to lock in gains, a good time to rehedge, and it was an affordable way to do it. So I do think it's interesting. We do watch the difference between the VVIX and the VIX, and to see that, this, I would call this speculative or institutional money usually, especially at that size, right? Trading 180,000 VIX contracts, spending 80 cents a pop. That is, those are institutions putting on a large position, effectively protect against the down move. And I'm not sure if it's going to come, and that's okay if it doesn't come, because you would assume they've got something that's offsetting that's going to make the money if the market continues to drift higher. And we haven't called this the wall of worry yet, right? Because we're not really climbing a wall of worry. We're climbing, but is there a wall of worry right now, Derek? Like, it doesn't feel like there's a worry out there.
Well, we'll start to hear that phrase, I'm sure, but I mean, it's the same worries before. I mean, it's the same. The recession's coming. If we have a shallow recession, then we're fine. If it's a deep recession, then we're not fine. The other shoe is going to drop. So I don't think it's the same as the past where you literally have people saying, oh, we're climbing a wall worry, but it's the same stuff. Like when you watch CNBC, the arguments of, oh, be cautious, and by the way, you still have people who are saying, I like the market, but I'd rather buy it cheaper. To those people, you could have bought it cheaper. You didn't. So I don't know. I mean, there's always something to worry about. That's why we hedge. And when you hedge, you have to worry less about all that stuff because you're not trying to pick the markets. But I don't know. I mean, this market right now feels like there's not worry, but there's not enough exuberance yet. It reminds me of 2013 a little bit, Jay, and that's actually the last VIX environment. If I was to say what does this VIX environment, VVIX environment remind me of? It's 2013, Jay.
Through 2017, 2018, right?
Yeah.
That lasted quite a few years.
That's right.
Yeah, that was a long period of time. Yeah, look, when you look at things like GDP, when you look at the the sentiment that we talked about, right? Like, yeah, things can continue to stay good, but I don't know. We had a conversation with one of our advisors today, and we were saying, look, we rehedged, and we're protected in one of our strategies from kind of at the money to down minus 20%. And his immediate reaction was, yeah, but you don't think that's going to happen, right? And no, we don't, but I don't know what's going to cause that to happen, right? So again, we take that with our hedged equity strategies. We definitely take the approach of always be hedged. Don't time the market on that. Take advantage of it when it's cheap to put it on. So, yep. That's kind of where we landed on that.
But we'll keep talking about this VIX and VVIX thing because it's almost like they're saying, yeah, you can buy some VIX options, but you're not getting them cheap. They were too cheap, and we adjusted. So that's the new reality of it. Jay, I want to get to some recommendations this week. And did you have anything? Did you watch anything? I got one.
So I started watching on Amazon Prime Reacher, which is the second season of that. The first 3 of those are out. I watched the first 2 episodes. Pretty good. Little flashes of cheesiness in it, but still enjoyable, and I will continue to watch that.
I did watch the Bosch Legacy, so I got that. That's on Freevee, which is on that weird Amazon owned streaming channel that has commercials. I thought it was really good.
Yeah, Bosch is always quality on Bosch. Agreed.
Yeah. So if you are, someone, if you haven't seen it, start on the ones that are on Amazon Prime. There's about 7 seasons, and then last 2 seasons have been this quote unquote Bosch Legacy, sort of after the other. But my recommendation this week, I randomly was on Behind Enemy Lines with Owen Wilson. I think it was Owen Wilson is in that movie. It was on again. Gene Hackman. About a pilot who gets shot down. He's behind enemy lines. I think it's solid. So there you go. It's 2001. I can't believe it was that long ago. I guess 2001 is 20. It's coming on 23 years ago. How does that happen? But yeah, Owen Wilson, Gene Hackman, and some other people. So there you have it. Have you seen that?
I have. Yep. It was a while ago. I'll give you another throwback that came up on one of our calls this morning. You ready for this one?
Yeah.
Strange Brew.
Oh, boy.
I think that was in the 80s, right? About the Canadians and take off, hoser, eh? So I throw 1983, that one out there.
Actually.
Wow. Either you look that up or you wouldn't surprise me. You're the smartest person on earth.
No, I knew it was the early 80s. I did look it up. Rick Moranis, though, is in that.
Yeah, that was funny. I won't date myself, but I was not out of high school yet when that was on. So there you go.
Yep. All right, Jay. We'll leave it there. Plenty to watch and learn this week in the markets. And we'll just wave at Jay Powell, say, keep doing what you're doing, Jay, I guess.
Yeah.
Or don't.
Third time, I'm going to say Tommy Cutlets.
All right. See you, everyone.